Hello everyone, it's Suslov, Head of Capital Markets at AD Mortgage, here with you for our AD Weekly Digest to share most recent economic news, mortgage news and non-QM news. In the past week we saw Freddie 30-year fixed rate climbing another 25 basis points and we're now at 5.89% for Freddie 30-year fixed rate. A&D has improved its non-QM rates by 0.375 percentage points in the past week, and our daily rates research show that AD rates today are the most competitive on the majority of scenarios on non-QM market in comparison to other non-QM originators like Angelo, QWM and West. As for the economy news, US equities posted gains on Thursday, mainly elevated by healthcare and financial sectors. Investors digested hawkish remarks from policymakers that all but cemented bets of a large interest rate hike later this month. The marketplace has priced in a 75 basis points increase at a September FOMC meeting, mirroring the European Central Bank's move yesterday of the 75 basis points due to the inflation that is going on in the Europe due to gas and oil issues. Aside from that, Page Book was released in the past week by Federal Reserve. And we have Billy Abrams here with us today to shed us more light on the economic activity nationwide and rates direction for the coming week. Hello Billy, how are you?
Hey Alex, I'm doing fine, hope you are as well. So you mentioned the Beige Book. The Beige Book came out this past week and it told us something we all knew, not to expect stellar growth going forward. Aside from that, it was an incredibly quiet week with regards to economic numbers. The only one that really got my attention is one that's usually the least important, and that would be the weekly jobless claims. And what I found interesting about it is that for the sixth consecutive week, it came in lower than expected, which is to say that for 6 consecutive weeks, the labor markets have stayed stronger than expected. The Fed, as I've said before, have two mandates. One is to maintain good employment, the other is to maintain price stability. With strong jobs markets, they really can be as aggressive as they want at the upcoming FOMC meeting next week. As you suggested, markets are expecting 75 basis points. That would put Fed funds at 3.25, and we'll see what happens from there. Tomorrow we get CPI, the next day we get PPI, Thursday we get retail sales and 8 other numbers. The Fed has said they will be data dependent, but again, with a strong labor market and having told us that they would raise interest rates until they could make sure that inflation was stopped and was not going to come back, that's what they would do. And so we have no reason to think that they won't stand by their word. So we're looking for 3.25 by next week in Fed funds. I would assume that would probably get to about 3.75 at the November meeting. And by December, we're probably talking a 4% Fed funds market. Absent, I won't say historic, but something approaching that inversion in the yield curve, it's kind of hard to imagine how we're going to get a strong rally on the coupons. Now, mentioning the yield curve, the 2-year and the 30-year last week made new high yields above those that they made in June, but only the 2-year and the 30-year. So the extremes of the curve went through the June yield crest. The middle of the curve didn't, meaning curve trades are dominating treasury traders and still leaving us with confusion as to what to expect from the 5-year and the 10-year and the mortgage markets which follow them. Alex, I'll kick it back to you, and next week should be a lot more fun. Thank you.
Billy, thank you so much for the overview. We're all looking forward towards the next week Fed's meeting, what it bring us, whether the 75 basis points would be supported, and what to expect from the next meeting in November. Thank you everyone for being here with us today for the most recent market and mortgage news. It was Suslov, Head of Capital Markets at AD Mortgage, for our AD Weekly Digest. Please make sure to sign up to our YouTube channel to stay on top of the most recent market updates, and make sure you subscribe to Billy's daily updates on treasury rates and market moves. Stay tuned.